In metals markets, the two big risks, of course, is China and whether it's going to keep the stimulus that has introduced in place, or there be an early withdrawal of stimulus. And the big question mark is, of course, if the US proposed infrastructure bill passes through the US Congress, that's also going to be another boost in the metal price, or at least sustain the price increase that we experienced so far.
Well, hello to viewers catching up on this virtual presentation that forms part of One-to-One Money Investments online content. I'm very pleased to be joined by John Baffes, who is a senior economist at the World Bank, specializing in global commodities. Today, we're going to be hearing all about their most recently published Global Commodity Markets Outlook, I believe. John, welcome, and thanks for taking time to present to us today.
Thank you, Adam. Again, I really appreciate the opportunity of having me in this meeting. What I would like to do today is to present the key findings from our Commodity Markets Outlook, which was just published, in fact, a couple of weeks ago, on April 20th. In this presentation, I'm going to cover most commodity markets. I will start with some trends and developments from a global growth and macroeconomic perspective, and then I will focus a bit on the general trends on commodity prices, and then I'm going to focus on three commodity markets: energy, metals, and agriculture. Towards the end of the presentation, I'm going to give you some the price forecast that we included in the Commodity Markets Outlook on April 20th. And there I will have the opportunity also to touch upon some key risks on the global commodity markets as we move forward. Beginning with the global macroeconomic environment, what we see here is to the left the global growth prospects with some historical perspective since 2015. And we do see the sort of stable global growth environment until 2019. And then we had the pandemic that hit the world in 2020, which brought the global growth to about minus 4%. Now, moving forward, we believe that for this year, for 2021, global growth is going to be 4%, probably a bit above 4% from a global perspective. Advanced economies, they're going to grow probably 3.3 to 3.5%, and emerging markets and developing economies probably more than 5%. Now, this is an important distinction that I would like to make between emerging markets and developing economies and advanced economies, is that the so-called EMDs grow at a much faster rate than advanced economies, and that's important because that's where most of the commodity production and commodity consumption takes place. By the way, let me say that emerging markets and developing economies account for about 2/3 of the global economy when they're calculated in purchasing power parity terms. Another note I would like to highlight is that the numbers I'm showing here are based on our January global economic prospects, which is about 4 months old, the numbers. We do plan to publish the new edition of the global economic prospects in June. And the early indications that are that the numbers that I'm showing here are probably on the lower end on the range. Probably the actual numbers for 2020 and 2021 for growth are going to be a bit higher than what I'm showing here. Now, in the chart to the right, I'm showing the macroeconomic conditions, basically the two important variables that matter for commodity markets. One, of course, is the value of the US dollar against major currencies, and we see that has depreciated quite a bit from the beginning of the pandemic last year until the first quarter, until the beginning of this year. Now the dollar has stabilized. There's, of course, a very important the inverse relationship between the US dollar and the commodity prices, most of which are traded in US dollars. When the US dollar depreciates, commodity prices in dollar terms go up, and that's perhaps one of the many reasons that we have seen commodity prices kind of having a sharp upward path for the last year or so. And the third variable is the interest rates, and we saw interest rates coming sharply down following the emergence of the pandemic. They stabilized somewhat since August of last year, and now they have reversed course, but still they are in negative territory in terms of real terms. Now, interest rates affect commodity markets in many and more complex ways. Of course, the obvious effect is in the precious metals markets, but also interest rates affect both consumption decisions and production decisions. When producers have access to lower cost of capital, they invest more, which means more supply down the road. And when consumers have access to lower cost of capital, of course, they tend to consume more and they tend to store more. So we have this interesting relationship between complex relationship between interest rates and commodity prices, and of course the negative relationship between the US dollar and commodity prices. Now, moving to the overall trends of commodity prices, we tend to monitor commodity prices in three groups: agriculture, metals, energy. Energy is consists of crude oil, natural gas, and coal, but crude oil dominates this component. Metals, we have the six, we include in our index the 6 base metals plus iron ore. And agriculture is a very wide, broad index that includes both food commodities, agricultural raw materials, and all kinds of food commodities, such as grains and oil seeds, sugar, beverages such as coffee and cocoa, etc. And there is a simple kind of a trend that has taken place since the low levels of the pandemic of April last year, and since then, pretty much all commodity prices, I would say, have followed an upward path. Energy prices have returned to pre-pandemic levels, but agriculture and metal prices have kind of reached record highs. Here it's the same indices, but we show them from a longer term perspective since January of 2011, and we do see that, as I said, agricultural prices and metal prices have reached record highs. For example, metals are, according to this chart, at the 10-year high, and agricultural prices are at the 7-year high. Now, let me focus on energy a bit, and here's the price of oil, again, since January of 2011. And what we see in the price of oil is that although there has been quite a bit of volatility during the past 5 or 6 years, including the volatility that we experienced during the pandemic period, but regardless of this volatility of the last few years, what we have in the market of oil, the price of oil rather, is that we have two averages that have kind of dominated or characterized the oil market for this 10-year period. It's the first period, which is until the summer of 2014, when the price of oil averaged above $100 per barrel, and then we have the, so to speak, post-2014 period, where the price of oil has averaged about half of that, a bit more than $50 per barrel. And what characterizes or distinguishes those two periods is the fact that prior to 2014, shale was not still a big part of the global oil market, and we had a lot of geopolitical concerns back then. But after 2014, the geopolitical concerns, for the most part, are not there. And we also have shale, which has become a major sort of dominant component in the global oil market. And those are, I think, the two big reasons, major reasons as to why we have those two different pricing levels. And of course, after 14, and this is something that continues today, we see a weakening demand for oil, not just for oil, for fossil fuels, because of the energy transitions and the environment, etc. So just to put again this price into perspective, it's very interesting when we put when we take a much longer perspective from the oil market, more than half a century of data, we see that the average oil price that we experience now, which is a bit around $6 per barrel in real terms, today's terms, we see that pretty much we're about the average of the entire period. So the price of oil today, I would say that is both very close to the average of the last 4 to 5 years, but also very close to the average of the half century of real oil prices. Now, what's behind the evolution or what drives oil prices? What we see is we experienced a huge drop in demand when the pandemic began, reaching a low level of consumption in the second quarter of 2020. And when we decompose the oil demand from in its three major components, diesel, jet fuel, which is for air transport, and gasoline, which is mostly goes for road transport, we see that a major hit from the oil market came from air transport, the jet fuel. While diesel and gasoline consumption recovered, I would say, much quicker, but they did not experience such disruption or decline as jet fuel. Today, what we see here is that diesel and gasoline have returned somewhat to pre-pandemic levels, not 100%, but I think they are about 95% pre-pandemic levels. Jet fuel still has a long way to go. It's about 20% below pre-pandemic levels, or 25, one quarter below pre-pandemic levels. So jet fuel has still a long way to go before it recovers. Now, in terms of demand forecasts and how major forecasting agents expect demand to unfold in 2021, in the chart to the right, I'm showing the forecast, the evolution rather of forecast by the International Energy Agency, by OPEC, and by the Energy Information Administration, which is a part of the US government energy, Department of Energy. And what we see, at least two of those three major agencies, they had substantial downward forecasts throughout the last 9 months, but now they have converged, and the expectation is that for 2021, the oil market is going to gain consumption, or rather for oil is going to increase about 6 to 6.5% compared to 2020. So we're going to see probably not a full recovery, but a partial recovery in oil demand within 2021. Now, whether demand will fully recover to pre-pandemic levels, that's a big question, and there are a lot of analysts argue that probably it will recover perhaps in 2023 or 2024, but there are some analysts that believe, and agencies also that believe that demand for oil will never reach the pre-pandemic levels, that is levels of 2019. In fact, this is the so-called peak demand hypothesis, which states that we reach the highest level of consumption in 2019 and the world will never reach that level of consumption again. But regardless of which hypothesis unfolds or materializes, the fact of the matter is that even if we reach the pre-pandemic levels, it's going to last for a few years, and then demand for oil along with coal, of course, is going to be declining. Now, going just a bit deeper on the supply side, on the oil markets, we see the chart to the left, which shows production cuts relative to January of 2020. That is 1 month, or rather the month that the pandemic began affecting the world. And what we see is, again, in the chart to the left, initially we saw the sort of the brief price war that took place between Russia and Saudi Arabia. That's what we saw. That explains the spike in oil production in April of 2020. But then when prices began declining, and in fact even turned negative for a day back in April 2020, the OPEC plus countries, which comprises of all OPEC countries, but plus a number of non-OPEC, especially Russia, which is a major partner in this group, the OPEC plus countries decided to engage in deep cuts in the supply of oil, or of about 6% when we compare it to global production compared to January 2020. And what's interesting is that the OPEC Plus group has been able to sustain those cuts throughout the period until March until now rather. So they have been very coherent and very strong in making sure that the cuts stay in place. And of course, that has affected the spare capacity, and what we see in the chart to the right, that spare capacity now, which is the capacity that has been held because of OPEC plus production cuts plus the pre-existing capacity, this spare capacity runs now at about 10% of the global production. And this is, of course, a very important variable, because this is a capacity that can come into the market at a moment's notice. This capacity can come very shortly if, for example, OPEC plus decides not to extend the cuts. And that's basically the most important risk in the global market, that this capacity sits on the side that can come into the market very, very quickly. Now, the two other, so to speak, risks on the supply side are we have Iran and Libya and Venezuela, which in the last few years have, at least Iran and Venezuela, Iran because of the sanctions and Venezuela because of domestic issues, they have experienced declines in the supply of oil. We had some issues with Libya early last year. Libya has come back into production partly. It supplies about 1.5 million barrels of oil in the global market. So the risk down the road from those countries is what happens in the Iran agreement if the restrictions from Iran exports ease, which means more oil is going to come from Iran. And we also have Libya, which may add some more oil to the global market, perhaps as much as 1 million barrels per day, if the conditions there, the conflict allows it. And to the right, we see, of course, the third kind of, so to speak, supply risk in the global oil market, which is what happens in the supply response from the United States, especially the shale oil. We had a huge reduction in the rig count following the pandemic, which went from from the Permian Basin, which is the most important producing region of the United States, and went something from 500 rigs down to 150 rigs. It has partially recovered now, but it's also important to note that when we take a look at the production per rig, what we see is the huge productivity gains that have taken place in the United States in the same sector. So this is the red line, which shows the production per rig. And that's the third risk in the global oil market from the supply side perspective, how the United States shale industry is going to respond, and whether more oil is going to come from the shale oil industry in the United States. So just to summarize, in the energy market, we have on the demand side pressures because of COVID, which have been somewhat eased lately, with the exception of air transport, which still lags behind the recovery. So that's the major risk, where we're going to have a full recovery on the demand side. And from the supply side, we have coherence, or rather whether OPEC Plus is going to follow through for the rest of the year with the cuts. We have Iran and Libya, and also the oil sector, the shale oil from the United States. So that was our view on energy. Now, turning to metals, we saw this huge increase in metal prices, which, as I mentioned earlier, have reached a 10-year high. Our index, that is, which includes base metals and iron ore, has reached a 10-year high. And here we have the global manufacturing PMI, which correlates very closely to our metal price index, and we see that as soon as the PMI began to recover in April 2020, metal prices are also recovered, have recovered since then. Our three reasons or four, I would say, behind the metal price increase. Of course, the most important reason is the quick recovery in China. China did not really enter a recession, so to speak, as most other countries of the world did. So China recovered quickly. China, as I will show you in the next chart, accounts for 55% of global metal demand. So the moment China recovered, that gave a boost in metal prices. We also had some supply disruptions in the metal prices, especially in the metal sector, especially from Latin America. And lately we have the announcement by the United States, which may spend, again, that's a big if it's passed by the US Congress, but they may spend perhaps as much as $2 trillion in infrastructure, and that's also a supporting element from metal demand. Now, as I said earlier, China is the major driving force behind the metal price increase, and we can see here that China, between 1995, when it was playing virtually no role in global markets, today accounts for 55% of the global oil market. And to the right, you can see the monthly growth of China demand that it suffered 1 or 2 months early in the pandemic, but since May of 2020, Chinese demand recovered quite quickly. And in fact, the latest observation that we had, which January of 20 to January of this year, demand in China increased by something in the neighborhood of 25%. Of course, you have to take into account the fact that this is year-on-year change. So we're comparing the last observation, which January of 2020 compares the growth of, 2021, compares the growth of January 2021 versus 2020, which was negative, as you can see. So part of the spike that we see in 2021 in January is also a statistical kind of artifact. But nevertheless, it's clearly from this chart that China has been both historically the main engine of global demand and the engine of global metal demand during the past 8 months, which of course coincides with a huge rally in metal prices. Shifting to precious metal prices, we do see, or rather we experience a diverging trends during the pandemic. We had gold, which pretty much went from reached a high of almost $2,000 a while earlier. So huge increase in the gold prices, but we experienced a huge decline in platinum prices, and this divergent trend is explained by the fact that gold is considered a safe haven asset. So in bad times and in times where recession looms in the horizon, investors turn to gold, and that's what we saw. We experienced this upward path early in the pandemic, which in fact had started much earlier than that. And then we saw the platinum prices pretty much collapsing throughout the pandemic, but that again is explained by the fact that platinum is consumed quite a bit of it. I believe about 50% goes to internal combustion engines for the car manufacturing, and because of the collapse in car sales and in the pandemic, that caused platinum prices to collapse. At this point, I would like to make an interesting kind of comparison and say that the three prices that were affected the most during the pandemic were, of course, oil, which, as I said earlier, it reached very low levels in the negative territory in April of 2020. Platinum, which we see here, experienced a huge decline early in the pandemic, and also natural rubber prices also suffered a lot during the pandemic. And it's not surprising because all three commodities, they have a major demand growth for those commodities is transportation fuel for cars, tires for natural rubber, and platinum for internal combustion engine. And to the right, we have I'm showing you the correlation between gold prices and the macroeconomic conditions, especially interest rate in this particular case. And we clearly see the correlation, the negative correlation rather, between interest rates and gold prices. And perhaps the easing of gold prices that we experienced the last couple of months may be explained by the fact that interest rate has turned a little, still a negative territory, but it has an upward trend. So the big risk, to summarize, the big risk in precious metal prices from the gold perspective is interest rates. If interest rates, monetary policy changes, which may change, probably not this year, but perhaps next year, then we're gonna may see a further easing in gold prices. Then another risk in gold prices is physical demand. We do experience some weakening demand from India because of the lockdowns and the problems that the country faces right now. So from our perspective, those are the two major risks in gold, the interest rate policies and the physical demand. And for the other precious metals, is industrial demand, which from the short-term perspective, platinum is good news, but from the longer-term perspective, then we have the issue of energy transition and whether platinum is going to be, again, a major component of car manufacturing or not. Now, lastly, let me briefly share my views, our views on agricultural prices. Again, we divide agricultural prices in three components: beverage, which is coffee, cocoa, tea, etc., raw materials, which includes the natural rubber and the cotton, and then the food commodities, which includes most grains and oilseeds such as soybean oil, palm oil, etc. And what we see in agricultural prices, we see this divergence that has taken place post-pandemic, a huge increase in food prices, which have reached a kind of 7 or perhaps 8-year high, and relative stability in raw materials and beverage prices. Relative stability has taken place throughout the last 5 or 6 years. Now, the reasons for the spike in food prices, well, there are, I would say, 3 reasons. The first is that agricultural prices and the US dollar move in they're inversely correlated, as I mentioned earlier on in the presentation. This is the case for all commodities, I would say, but for agriculture, this inverse correlation, negative correlation between price and US dollar is much stronger than other commodities. And we do see here that the spike in agricultural commodity price index corresponds with the decline in the weakening of the US dollar, but that explains about, I would say, 1/3 of agricultural price variability. Then to the right, we see some weakening in supplies relative to demand. Those is a measure that we use in agricultural prices, rather agricultural supplies, the so-called stock-to-use ratio. So we measure the stocks at the end of the period and we compare them with consumption. And when the stocks relative to consumption going down, that's an indication that supply conditions become tighter. And although this stock-to-use ratio is much higher than the levels we experienced back in 2005 and 2006 that led to the price spikes of 2007, 2011, the stock-to-use ratios today are perhaps twice as high as compared to that period back then. That's one of the reasons we believe that the spike in agricultural prices, or in food prices rather, that we experienced recently, we don't think this is a permanent sort of increase in agricultural prices. We did have some supply disruptions, sort of shortfalls, I would say, in agricultural, in grains, and also lately in edible oils. In edible oils, we had some La Nina supply reductions in South America and also in Southeast Asia, in palm oil, and on for grains, we had some problems with the maize crop in North America, and that's one of the reasons that we observe this spike in food prices. Another reason behind the spike in food prices is strong demand by China. Last year and the year before, China was hit by the African swine fever that affected its hog population a lot, as much as 2/3 or 3/4 of its hog population was decimated. Now there's a recovery in the hog population in China. That's also has pushed demand for some agricultural food commodities, for animal feed, has pushed demand and consequently prices to go up. Now, before I conclude, just to show you our thinking about for commodity price forecast this year and next year, we expect energy prices to average 36% higher this year compared to last year. Most of the price increase has taken place so far in the first quarter of this year, so we don't expect any further increase for the remaining of the year. In terms of non-energy commodities, both agricultural prices, metals and mineral prices are expected to be much higher this year compared to the past year. 20% higher, 14% higher agricultural prices and 30% higher metal prices. For next year, a very small increase in energy prices, not small, it's 6%, small compared to this year, but not small by longer term perspective. Non-energy prices we expect to ease by 3.5% next year. Most of it is going to come from metals and partly from fertilizers. We do expect a little increase, about 1% in food prices for next year. Now, what are the risks to this outlook? I went through the risks extensively, pretty much in the energy section discussion. We have 3 risks in energy: what's going to happen to US shale, how it's going to respond to the recent boom in oil prices. We have the cohesion, or whether OPEC is going to keep the cuts in place, for how long rather OPEC is going to keep the cuts in place. Then we have demand weakening due to COVID. We have some 3rd or 4th waves of COVID in some parts of the world. We do have vaccination that progresses very well in some countries, especially in the developed countries, not as satisfactory as in the emerging markets and developing economies. So there are still some growth questions that may materialize, sort of negative news with respect to COVID. And that's the 3rd risk in the energy markets. In metals markets, the 2 big risks, of course, is China and whether it's going to keep the stimulus that has introduced in place, or there will be an early withdrawal of stimulus. And the big question mark is, of course, if the US proposed infrastructure bill passes through the US Congress, that's also going to be another boost, give a boost in metal price, or at least sustain the price increase that we've experienced so far. Now, in agriculture, a key component in the agricultural sector is energy prices, which because most food prices are energy intensive from the input cost side. So if energy prices are kept at a high level or continue to be high, then probably that's going to keep agricultural prices, especially food prices, higher, much higher. And lastly, in agriculture, we have the biofuels question. And with the energy transition, there has been a lot of announcements and by a number of countries that they are going to sort of further their mandates for using food commodities to the production for biofuels. That's part of the energy transition. So if that materializes, of course, we're going to see further increases. We could see further increases in food prices. But this is something of a medium-term risk because if, in fact, those announcements materialize, that's going to be something that's going to take place for the next 3 to 4 years, not something that's going to materialize quickly. And with that, I would like to end my presentation and just to let you know that you can access our commodity market outlook, prices, some blogs that we publish in the specific sections on various commodity markets, as well as our price sheet that goes up out on the second business day of each month. All those are freely available at worldmarket.org/commodities. And just to let you know that today we published, or we are going to publish the price database for the month of April. So again, thank you very much for giving me the opportunity to present our recently published commodity markets outlook.
Excellent. Thank you very much, John, for the commodity markets outlook. That's great. I just wanted to ask a couple of questions to probe in a bit more detail on the energy and the metals side of what you've presented. And obviously you spoke about the energy transition there. But I wondered if you had anything more specifically on your outlook for how electric vehicles are going to impact the recovery narrative for oil, or is it not? It's not as straightforward as that. Maybe it's a bit more nuanced over the next decade. But how do you have any projections around how fast the energy transition is going to be coming, and also how quickly the EV adoption rate is going to change the energy landscape?
Yeah, thanks, Adam. You asked a very good question, and probably the most relevant question, I think, the most important rather question for commodity markets. This is something that we'll start sort of analyzing even more detail. Just to let you know that in our next edition, the October edition of our commodity markets outlook, we're going to have a focus section which precisely is going to try to answer this question, namely how the energy transition is going to affect the various commodity markets. And it's going to have effects on all commodity markets. Of course, the last thing that I mentioned about agriculture, but the major effect, the most important effect is going to be on the fossil fuels, especially oil. And that's why a lot of analysts argue whether the oil demand may have reached the peak in 2019. But most importantly, this energy transition is going to affect a lot of metals, because electric vehicles are more metal intensive than the internal combustion vehicles. So we are going to see some huge increase, we believe, in copper, in the demand for copper, probably some of tin, of course, the other metals such as lithium, cobalt. Now, how much demand we're going to see, it's still a big uncertain. We still don't know whether this energy transition, especially the electric vehicle adoption, how fast it's going to spread throughout the world. But we do believe this is going to be, as I said, the key driving force behind the metal demand for the time to come. Now, one thing that I would like to highlight here, however, is that's very important, is often when we make projections for commodity demand, whether it's metals or energy or other commodity markets, due to demand shocks, in this particular case, it's the energy transition, inevitably our projections are based on existing technologies. That's obvious because we cannot project, we cannot forecast which technology is going to come, which innovation is going to come, which technology is going to dominate the market. So one caution that I would like to highlight when we are analyzing commodity markets is to have in mind the fact that we may see technologies down the road. Again, I'm not aware of any technology, I'm not an expert in technology, but we may see technologies that are may be used strongly and favor one commodity over another. So a big uncertainty on the EV, or rather the energy transition, and in particular the EV adoption, is going to be what kind of technologies we're going to see down the road. And again, this is something that I cannot comment on.
Yep, absolutely. Hydrogen comes to mind, for instance. Scalability isn't there yet, but the technology isn't certainly too new. It's just a question of hydrogen fuel cell technologies taking off and the investment needed to get that market scaled. And then suddenly you have a competitor for EVs and ICU engine.
Yes, that's right. And also you have the storage, electricity storage issue. I mean, we can produce electricity from renewable sources, but then you have the fact that you can only produce from winds when the wind blows, or from solar panels only when the sun is shining. So when it's dark or it's quiet out there, you cannot. So the question is, can you save the obvious question of how much electricity can you save? And there we see a lot of technologies that are at an experimental stage. And what we do not know right now is what technology will dominate sort of the electricity sort of storage down the road in 3, 4, or even 5 years from now. And depending on this, then that certainly is going to affect the adoption of electric vehicles, etc.
Yeah, certainly. The amount of stimulus going into things like renewables and the US infrastructure bill and the recent announcements from US Energy, I forget the title, but the Department of Energy head announcing that they would put a certain amount of trillion into renewables as an industry for jobs, but also for production within the US. It's quite significant. Do you have anything that sort of looks at renewables, or how much that is defining your projections?
We don't know yet the exact amounts because there's a lot has been written and a lot has been discussed. There is this number of $2 trillion, which is quite a lot. It's quite a big number, and that's certainly is going to affect both the renewable energy and the transport and the metals demand through general infrastructure spending. Now, one issue in the United States, as you probably are aware of, is that how much money goes at the end of the day. It's going to go at the end of the day in this bill. It depends on how this bill evolves as it passes through the legislation, and whether it's passed, it's voted or not. So in the United States, you have announcements, and between the announcement and the actual outcome, you have quite a few steps that are certain there. It's not like a decision is made as in other countries by the authority, and that's the end of it. Here we have a lot of steps. But our sense is that the current administration in the United States is very sort of serious, so to speak, driven to attack or to address both the infrastructure needs of the country as well as the energy transition. So we do believe that's going to, both metals and renewable energy are going to be benefit from the demand side, at least, from changes, both policy changes and fiscal sort of.
Yeah.
And so because you have two sides, you have also the regulatory, the policy side, as well as the actual spending side. So you have two kinds of benefits.
Yeah, absolutely. Yes, it would seem the policy application is definitely there for this transition. Right. My other question was around the sort of scenario in global markets at the moment, where with interest rates so low, the allocation of capital into other sectors, or indeed equity markets booming or opening up compared to how they have been in more bearish years previously, and with rates so low, on bonds or treasury notes, this creates, a lot of heat in the market, which can be good for capital flows coming into new projects that need to bring supply online. If we're talking about all these commodities, so do you think this lower rates for longer, or even negative rates, is going to be is going to continue to drive the commodities story, not just so that it's not just the demand that we're seeing that's driving it, it's also the scenario in the macro scenario that's actually really helpful commodities, because they are real assets at the end of the day.
Yeah, that's a good point. In fact, as you said, or implied at least, that the low interest rates help, so to speak, or affect commodities in two ways. One is the physical demand and supply, consumers have access to cheap money, producers have access to cheap financing, they produce more, they consume more. So that's one aspect, and then it's the investment aspect. When you have money, you have investment. When you have cheap kind of low interest rates, you have investment money that comes from the commodity markets. Now, how much of the price increases we have seen recently comes from the real side, and how much comes from the so-called monetary side, I don't know about that. I would say that the real side is more important, real meaning the consumption of the investment side, the real investment side, which generates supply response. Now, the amount of money, of course, we have seen a lot of money coming to investment funds, investing in commodities, but I don't think it's going to have a longer term or medium term impact on commodity markets. It probably affects prices on a month-to-month basis or perhaps on a quarter basis, but I don't think this is going to be the driving force in the longer term. In the longer term, I think if interest rates are kept low, you're going to have the exchange rate channel and the demand channel and the supply channel that's going to affect commodity markets mostly.
Absolutely, that makes sense. Great. Well, John, thank you very much for presenting that to us. It's really good to get the outlook from you and from the World Bank. And it's great having you sharing that presentation with us. And we look forward to catching up again on the next edition with some more information around the EV outlook as well, as you mentioned.
Okay, Adam, thank you very much for having me. It was my pleasure to present our material. And again, as I said, in our next edition, we're going to look at the issue of the energy transition and how it plays out with various commodity markets. That's going to be in late October.
Excellent. Yeah, and hopefully we can do something again around featuring that. Very good.
Great. Okay, Adam. Thanks a lot.